Okay, so you're welcome to IFRS 2 on conceptual frame, IFRS 2 on share-based payments. Okay, so what are we looking at here in IFRS 2? Now, for transactions commonly, when entities consummate transactions, right? The way it's consummated is that we would have somebody that wants to buy goods or services, right? And the seller will simply transfer that goods or services to the buyer. And it's expected that the buyer would Will settle up either immediately or later, right? So ultimately, it will pay, right? We pay that consideration in money ultimately. But we have seen in recent times that most entities don't want to, or they are replacing this form of consideration with another form by using their shares or share options. What we want to look at today is if the mode of payment to the provider or supplier is your shares or your share option, then how do we account for that? How do you recognize that in your books? And how do you measure that in your books? Majorly, that is what we want to look at today. So where we are starting from is this. Where we want to be is here, when we have this type of transactions. But let's see if you even understand where we are coming from. So if an entity sells goods or services, and in return it gets money, in return it has to pay money. How do you enter that in your books? You debit purchases, you credit cash, or what? Or bank. That's my girl. Yeah. So you see, this one will happen. This one will happen if you are paying that money immediately. You know, it's possible that you can defer payments and pay maybe after 2 or 3 months. So in that case, it won't be bank or cash you'll be crediting, but you're crediting what? Yeah. And again, it's not every goods you buy that you intend to resell. It's not everything you want to resell. There are some that you bought it to use it in your business. Then we'll be talking about assets or expenses, as the case may be. Like if you take the service of a professional accountant, for example, or even an audit firm. If they audit your books, it's a service they are provided. You won't debit purchase. What you debit is a professional fee and credit bank or cash when you eventually pay them. This is where we are coming from. So where are we going? See, where we are going, this one will remain. Nothing is going to change here. Where we are going, it won't change because we are still acquiring goods or services. What is changing is now the what? Is the form of payment. Because now we are now paying with our shares or share option. And that is where we are today, IFRS 2 on share-based payments. Okay, so how does this happen? It happens in 3 ways. It happens in 3 ways. Number one, so the forms. How do we pay using our shares or share options? The first form is this. Listen up. I'm not dictating, I'm explaining. Now, I'm not at a point where what I'm saying is not dictation, but explanation. Even though I'll be repeating it over and over again, just for clarity. But you can jot, of course. Now, the first form is this. An entity might receive goods or services, and in return, the entity would promise a consideration of shares or share option. That's the first form, like I've mentioned before. And this form is called in IFRS 2 and equity settled share-based payments. And equity settled share-based payments. So the major features here is that you are paying with either your shares or what? Or your share options. That's the major feature there. That's one. The second form is that an entity can receive goods or services. And the form of consideration is that it will pay cash. But that cash will be dependent on the value of the entity's shares. I repeat, an entity will receive goods or services, and the consideration it will still pay is what? Is cash. It will pay money. But the amount of money it will pay would depend on the share price of that company. So they are linking what they want to pay with their share price. They are linking what they want to pay with their what? With their share price. I receive goods and I'll pay cash based on my share price. Karen? The buyer, of course. The buyer, of course, is the person that is buying. Then I will say, I will pay you, but I will pay you based on the value of my shares. Okay, so you see, everything I'll be discussing here is not from this guy at all. We don't care about how the seller accounts for it. We only care about how the buyer accounts for it. Because our attention is the payment, how he's paying. So, see, this second one I mentioned is that, okay, I want to pay you cash. But the value of cash I will pay you is, I would link it to my share price. I will link it to my share price. You see, the only, for the companies that can do that are companies that knows that their share price is attractive. Because you will not agree that with any company. It has to be companies that has good fundamentals. Companies that are doing so well. Imagine a Google allowing you that kind of deal. That ordinarily, if you have just accepted money based on money itself, you might lose out. But if the guy says that, see, I will pay you based on if my share price goes up, your money will go. So he's attaching your payments on his share price. Because he's confident, he knows that he has good fundamentals and good technical history. So he knows his share price is going to ultimately go up. And this type of share-based payment, they call it what? They call it cash settled share-based payment. So this is majorly, he's paying cash. That's why it's cash settled. But it's dependent on the entity's what? Share price. And like Karen asked, he's the buyer, not the seller we're looking at. Is the person that is paying. And the common one that we use here, they call it share appreciation rights. So the agreement will have been contained in what they call SAR, share appreciation rights. That's what they call it. While in this one, they call it share options majorly, or just the entity's shares, as the case may be. Oh, definitely, there is a difference. There is a difference. This one is where we are giving you shares outrightly. This one is not shares, but a promise to give you shares. So it's just like I'm giving you the right to buy my shares. Don't worry, I will get there. I'll pick them one by one. Okay, so that's the cash settled share-based payment. And the third one, that one, the entity receives goods or services, then it now gives the seller a choice. It gives the seller a choice between accepting consideration in the form of shares or share option, or accepting cash based on the value of the buyer's shares. What that simply means is that the buyer is giving the seller choice to either choose equity settled or cash settled. Okay, that's why they call this Equity or what? Or cash settled what? Share-based payments. So it's giving the buyer a choice. So here we're going to be learning about compound instruments because this is a compound instrument. When we get there, we'll learn it. Of course, we cannot get here today. Realistically, I will only get here today. I will explain this in detail today. Then next week, we'll finish up with this. Then probably, I don't know if Mr. Kazim has taught you different tax. Okay, good. So we are going to consider different tax implication of this, which you would tell me from the way I've explained this transaction. You should be able to tell me the different tax implication. Okay, so we'll pick it one by one, and majorly we'll focus on recognition and measurement, and finally disclosures, because IFRS is all about recognition, measurement, and that's everything we'll be talking about. So let's pick it one by one. Okay. Any question up until now? No questions. Okay. You have not been doing the way you used to do in FRO. You are getting soft though. It's not. Karen. Karen, I'm enjoying your questions, but allow them benefits now. Don't worry, don't worry.
Regarding the cash base, you are saying that it is based on the share price of the buyer. And you also said that the higher, I don't you think it will not benefit. It means the buyer is going to have to pay more money.
Yes, now.
Why should I want to pay more money?
Well, you are when it comes to because all he's just doing, the buyer is not ultimately paying more money. All he's doing is that he's attaching your success to my success. Because if my share price goes up, it's not like I paid money for my share price to go up. It's just like I'm doing well as an entity. And for anybody to achieve that deal, that person must know that this company has good potentials, that his share price will definitely go up. That's why they are linking his payment to his share price. Otherwise, nobody would do that. Yes. Nobody will agree that kind of deal. They will say, please give me my money and let me walk away. Good question, Karen. Okay, so let's start with equity settled. You know that I keep forgetting your name every time. You. Elisha, don't say because now I've said you don't start asking me nonsense questions. Equity settled. Okay. Yeah, focus. So let's start with equity settled share-based payment. Actually, they actually asked this last diet, question 6, 10 marks. Very simple question. Is on deferred tax implication of share-based payments. We'll solve it. Probably I will give you as your test, maybe next 2 weeks or thereabout. But how do you recognize an equity settled share-based payments? Now, before we get there, let me try and explain some background to you as far as equity settled share-based payment is concerned. And no, let me go straight to the recognition. The background is not going to help you yet. It's when I get to measurement that the background will help. So recognition, recognition talks about at what point do you include an element into the financial statement, right? So you recognize an equity settled share-based payment when the goods or services are received. You recognize equity settled share-based payment when what? The goods or services are what? Are received. That is when you put it in your book, when they are received. Now put or as they are being received. Or as they are being received. Sorry? No, no, no. It really doesn't. We are saying that the only point where you put it in your books is when the buyer has received the goods. So I didn't get your question very well. Sorry. Yes. 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 Yeah, correct. When the goods are received, not when the cash is received. Right? Okay. So it's still in line. It's still in line. So now, see, we mentioned that when the goods are received, that is a situation where the service is happening almost immediately, right? But that's not the case in most instances. There are some services that can span 2 years. So you don't wait until you receive service for 2 years before you put it in your books. In reporting, periodically, you have to look at, okay, what have we done up to date? We put that in our books. That's why I have all as the services are being what? Received. That's for situation where there is instrumental delivery of the service. Okay, and that's the recognition. It's not more than that. That's the recognition. That's recognition of equity settled. Now let's go to the measurement. Measurements. Again, or let me ask you, let me see if you can give it a trial. Now, there are two things involved here. There is the goods or services received, which you have a value. Of course, goods or service you have a value. And now there's now shares involved, which will have a value. Shares has its own value. So, what do you think? How do we measure it? Because now we have two varying valuation choice that we can choose from. Is it that we are choosing from the value of the goods that we are receiving, or we are choosing from the value of the shares or share option that we want to what? Give out. Which do you think will be more appropriate to use? No, value of the goods or services received. Okay? So note it that equity settled share-based payment is measured at the value of the goods or services. Equity settled share-based payment is measured at the value of the goods or what? Or services. Listen up. Ultimately, this is only practicable when we are dealing with an external consultant or an external supplier or a provider outside. That is when you can determine the value of the goods or services. But the reality is that this arrangement is not common with those people. It's not common with them. In most instances, most supplier wants to collect their cash outrightly, irrespective of how your shares is doing. They need their money almost immediately. But that I've given you, that what IFRS 2 mentioned is mostly applicable to external supplier, external consultants. That is when you can measure the value of the goods or services. However, this arrangement is mostly common with employees. In Nigeria, you see it often with directors. When you become a director in a company, mostly they will give you that some of the shares of the company, that take some of our shares, but they will now put condition on it, right? But if you are dealing with employees, it's not really possible to measure the service that the employee is providing. It's not possible. In that case, we cannot use the valuation looking at it from the goods or services if it is dealing with whom? An employee. So you're writing, if the goods or services cannot be measured, if the goods or services cannot be measured, yes, sir.
The number increase drastically nígbà tó ń gba list.
Can you
Báwọn
imagine?
population wọn tó wà ní class.
Ojú.
Next week ní ìjọba ẹgbẹ́ ṣe a máa follow ẹ̀ ọ́
Of course,
a máa sọ fún ọmọ online when you are coming to it.
ID card. Fún àti sọ fún ọ lẹ́nu pé kó gba ID card. Okay, so when the fair value of the goods or services cannot be measured. You measure equity settle, or don't let us write those story. It is measured at the fair value of the shares or share option. Yes, it is measured at the fair value of the shares or share option. It is measured at the fair value of the shares or share option. Okay, now let's now go to fundamentals. I've explained the core principles to you. I explained the core principles to you. Now, when it comes to measurements, the only thing I've mentioned is fair value of the shares or share option. Abi? Let me start with the fair value of the shares. I'm not dictating. I don't know why you're writing that as an heading. Now, the fair value of the shares is majorly the market price of the company. Is majorly the market price of the company. And this is only relevant where the provider provides the service immediately. That is when you want to issue outright shares. Where the provider provides the service what? Immediately. And that is when you issue what? Outright shares. If this is the situation, it's not difficult at all to account for. It's just for you to debit the services. If it's from an employee, you debit staff costs. If it's for maybe you bought an asset, you debit assets. If it's you bought good and you want to resell, you debit purchases. And you simply credit equity. You credit your share capital. So it's straightforward. If what you are giving out is what? Is shares. So that is not difficult. And you will not find that in your exam. The examiner will not ask you that because in most cases, when they have asked share-based payment as a singular 15 or 10 marks question, it doesn't deal with the buyer issuing shares, but rather the buyer issuing what? Share options. Right? Because shares is outright. Please, my friend. Share capital. Yes, because you have issued additional shares. You have issued shares. Exactly. It will go up. Okay. You want to ask a question? Okay. So that's for shares. So we won't talk so much on that. In fact, I won't mention it again because it's straightforward. Now, what you find in your exam is for share option. He asked me the difference the other time. You see, share option is a right. Share option is a right that the buyer gives to the seller or that is given to another party to buy the shares of the entity at a future date. Is a right that an entity gives to another party, be it a supplier, be it an employee, be it whoever that has provided service, to buy the shares of the entity at a future date. And it is always at an exercise price. It is always at what? At an exercise price. So, and that exercise price will have been determined right from the date of the agreement. Right? But what I want you to take home right at this moment is that share option happens in the future. It's not something that happens now. And usually there is always an agreement that, so share option is always represented by an agreement. So you have a paper with you that will show that you have been given a right to buy a certain number of shares of this entity, and it will be at a price, at an exercise price. In fact, the date has to be specified at a future date, specified future dates. You get it? You get it? Karen, you're okay? Okay, now my question to you, if you get that. Since you know that this share option will be consummated or exercised at a future date, at an exercise price that will have been determined today, right? That will have been determined today. You are going to ask a question because I know it will make so much sense that you have determined today. So let's say that the exercise price is, let's say 2 naira. No, let me say 5 naira. Let's say it's 5 naira, the exercise price. Now, the share price of the company today, we are looking at today that we are doing the agreement. Do you think it should be higher or lower than that 5 naira? Lower, Abi? You all agree? You disagree? Should be higher. And you're correct. Yes, it has to be higher now. If it's lower, it's not attractive now. It's not attractive. Why will I want to do that? Why will I want to do that? So I want to bank that your shares will increase. What if it doesn't increase? So from today, it has to look very attractive. Otherwise, why would I want to key into your share option when I can just go and buy it on the secondary market for a lower price? So they always make it extremely attractive. They always make it what? Extremely attractive. Okay, you raised up your hand. Yeah, okay. You wanted to ask a question. Please do. Okay, the exercise date.
Run out.
Okay, I know it was going to make sense. So she said that at the agreed date, future date, if your market price now becomes lower than the exercise price, okay? Ordinarily, I will teach you modification next week. Equity settled share-based payment is always modified or repriced. So they will reprice the exercise price. When they see that the share price of the company is becoming unattractive or becoming lower. So if the share price of the company, let's say they set it initially at it's 7 naira and the exercise price is 5 naira. If the share price become 4 naira, the exercise price must become 2 naira. Otherwise, people would not find it attractive. People would neglect it and leave it. Exactly. Exactly. It can be modified. Yeah. Okay, another fantastic question. If they need their money before the exercise, that means they want to come and cancel the contract, right? So it depends on the agreement, really. If the agreement has, I'll still talk about vesting conditions. If they don't meet the vesting conditions, then that means they are not going to get it. They will give everything up. Okay, that's why it's majorly common with employees. They will give everything up. So they have to meet vesting conditions. So I've said a lot of things. So let me just take it slow. Now, apart from this fair value of shares that I said is not common, another thing I've mentioned is what? Fair value of what? No, what I've done is to explain what share option is. Abi, I've not mentioned this. I've explained what a share option is. And I say that this share option is usually exercised at a future date, which is called what? Exercise price. And I gave you an example of how much? 5 naira. And I said it should be different from the share price of the what? Of the company, which we said an example is 7 naira. I just gave you as an example. These are share options work. So this is the price at which you buy those shares in the future. Why this is the share price of the company today. But I also mentioned that these things can be repriced depending on the share price of the company. But what name do you think we can give to this 2 naira as of today? This difference. This difference. What name do you think we can give to it? What do you say? Yeah, premium. Yeah, no. It can be premium. Interest. Wherever. It doesn't really matter. Wherever. Detaji, what did you say? Deficit or surplus? Not really. Not really. You see, to whoever it is that is taking up this option, if it is me, one way or the other, I know that I'm gaining how much? 2 naira as at today. So to the seller or to the provider or to the employee, let me restrict it to employee. To the employee is gaining how much? IFRS 2 call this intrinsic value. That is what IFRS 2 called it. Intrinsic what? Value. Right. Where I'm going is this. Look up. You see, Yes, we measure it. If you look at what I told you about if the value of the goods or services cannot be measured, I said it's going to be measured at the value of what? Shares or what? Or share option. Abi? We have cancelled out shares. We said that one is majorly with external consultant. So that means if it's not shares you are issuing, that means it's going to be what? Share option. Now, that means we have to, one way or the other, get the fair value of the share option. It's not the exercise price, neither is it the what? It's not the share price. Because it's just the market price. If you are using shares outrightly. So the fair value of, of the share option, they will give you in the exam. In any exam you're writing, it will definitely be given. But in practice, when you become accountant, nobody will give you anything. Okay, so you need to be able to determine these things. And the way IFRS 2 says is determined is that it should be based on the share price of the company. Okay, it should be based on the share price of the company. And mostly it should be equal to the what? The intrinsic value is the attractiveness of the share option. In fact, it is the value of the share option in its own right. That is why people want to key into it. It's because of that value, that extra benefit they are going to get from exercising this share option at a lower price than the share price. That is why they want to key into it. And that is how, more majorly, they value it at what? The intrinsic value. Okay? So, majorly, the fair value of the share option should be equal to what? The intrinsic value. If it is not equal, if they give you the fair value of the share option in the question to be 3 naira, no problem, use 3 naira. But you as an accountant, you know that the reason why the fair value of the share option is this is because they know that the share price is going to go up by at least 1 naira. Yeah, because ultimately at settlement date or at exercise date, they will be the same. It's going to be the same because they will have gotten the pricing right. At that time, we will know what the share price actually is. We will know. At that date, we will know the actual intrinsic value, which must be equal to the what? To the fair value of the share option. Okay, so that is how it is determined. But in the exam, they would definitely give it to you. Those are all the background. Any questions? You're back.
You said it in basic value is basically for the buyer.
Yeah, the provider. This one, the intrinsic value is for the seller who is the provider of the service. So that's the implied benefits he is getting.
I am talking about the difference of
Mm-hmm.
to the seller now. Sorry, to the buyer. The buyer sees that to naira in value. But to the seller, that shortage of 2 naira. What is it for?
It's really not relevant to the seller as of today. Okay, it's really not relevant to the seller. It doesn't have a name. It doesn't have a name they call it.
I was actually thinking because shares are like you share premium at I couldn't get the last lecture. I was thinking over it before you do that. If it's not it can't be share premium
And it can't be share discount because I've not really issued any shares. Do you get? They have not really issued any shares. So to them, majorly, it's just the value of the option. To them, it's just the value of the option. So you can see it as that if you want to. Karen, so let Karen go first. No, I've left shares out now. We're focusing on share options. Yeah. If I don't receive the goods, there's no point. I have to receive the good. It's very important I receive the goods. Okay. It won't be a liability to be an option reserve under equity because we have not issued out the shares. We'll just be keeping the amount we promised to give in the future as an option reserve. It's an option until the exercise date. Okay, so the fair value of the share option is like share option is an agreement, right? So the worth of that agreement is the fair value of the share option. So it's always priced at the fair value of the share option. If they are issuing a share option, if they were issuing shares outrightly, it will have been priced at the market price of the company, publicly quoted, right? But if it is share option, because we are not giving shares now, so we have to find a way to value it. So it's the fair value of the share option. And I've told you here that is majorly the intrinsic value of that arrangement, which is the attractiveness of the arrangement. Same question. Okay. Okay. Majorly, that is where it can be attractive. I'm not sure it will be attractive for unquoted. But what most these tech companies do today is that they always do share options too. Even though they are not quoted, but they find a way to value all of these things. Right? They find a way. So it's not, I won't say it's applicable only to, but it's popular with them, right? But you see all these startups doing it now just to attract huge talents, right? Another question? Okay, no more questions. That means you get it up to this point. Now, okay, usually, share option, as we have mentioned it, is not something we give now, something we give at a future date. And the only reason we are doing that, okay, yes, yes, it's always a specific date. Yes, they will have known it in advance. Yes, it will be indicated in the question. Yes. So since it's always given at a future date, and the only reason for that, why it is given at a future date is because they expect the provider to offer services for that period. Okay? And share options come with what we call vesting what? Conditions. It comes with vesting conditions. Almost all share options, it comes with vesting conditions. So these vesting conditions are majorly performance conditions. They are majorly what? They are majorly just performance conditions. And when we talk about performance condition, the popular one that you find in your exam is the non-market condition. Is the non-market condition. And why is it non-market? Is because it only relates to something like service periods. Service periods. You find out that they will say that before you can take it, you must work with us for 5 years. You must work with us for 2 years. You must work with us for 3 years. That is always mostly going to be the condition that you're going to find in the exam. Service condition, because that is the one that will require a lot of work, right? Service period. So work for a certain period and you get it. Another one is just maybe they will give them a profit target or a what? Or they give them a sales target. These are non-market conditions. If there is no market condition, that means we could have market what? We could have market conditions. Abi? And this market condition majorly relates to increase in the share price majorly relates to increase in the share price of the entity. So if the share price of the entity increases, that will have been a condition they will give to you that before you can get this option, before you can exercise it, then our share price must increase from point A to point B, right? But when we see that in the exam, like most assignments I will give you, when you see market condition, it usually do not affect our calculation. It doesn't. Because at an higher level, they will have considered it in determining or in pricing the fair value of the what? Share option. That was what I was explaining to you, that this depends on the movement here. Because if the share option is not equal to the intrinsic value, it's because they know that this one is going to what? Is going to go up. So this is not always an issue for us. They won't test this in the exam. Though it's part of the condition they give, but it doesn't affect accounting. It might affect the exercise. I mean, if he doesn't meet this condition, they might not eventually give him the option. He might not be able to exercise it. He might not vest, as the case may be. But he has to meet it, but it doesn't affect how we account for it. Okay? And that's that about this. Now, the final thing is this. The final thing is this. Because this thing takes years for it before it gets exercised. So the way we have to approach it is that we have to approach it in a way that at each reporting date, we have to be account for it as they are offering the service. We will not wait until the end before we account for it. Every year, we need to account for it. And reasonable people would know that this share option is only given to those that will eventually meet the performance condition, be it service period or whatever. Those are the only people that will get it, right? If you don't meet the service period, it won't vest. You have to be there. If you are an employee and we give you a service period, you have to be there till when we want you to be. If you are not there, you won't get it. So even when you are valuing it every year, the valuation will be based on the number of employees that would meet the service period. Right? It will be based on how many? The number of employees that will meet the what? The service period. And that is all the explanation for equity-based, share-based payments. Okay? Or equity settled. Okay, it's quite unfortunate that that is outside the scope of IFRS 2. And again, IFRS 1 says that, IAS 1 says that, or even conceptual framework, a reporting entity must not have an intention to liquidate. So if the company liquidates, it goes into receivership, then liquidation. It follows that process, right? So there's a process for settlement. There's a process for settlement. We settle creditors first, then employees, then shareholders. No, we won't settle them on the assumption because they did not make the service condition. What did you say? Sorry? Okay, their lawyers will take that up. Okay, Karen. Yes. No, nothing. You have to meet it 100%. Either you meet it or you are out. Let's open our pack. For those, I want to believe all of you have packs.
Yes, sir.
Let's open our packs. Let's go to page 20, question 2.4. Page 20, question 2.4. We usually read in this class. Somebody pointed to Elisha. She pointed to Adeteju. Pointed to her.
He's our reader.
Okay, Adeteju, is you I want you to be reading in this class. Oh yeah, read please. Page 20. Is this old or new pack? Oh. Don't get the new pack. because there are a lot of changes, huge changes. Oh yeah, data you wait, please. Hold on. Let me give it to her.
Enter
Okay. On 1st January 20X1, an entity grants 100 share options to each of its 400 employees. Each grant is conditional upon the employee working for the entity until 31st December 20X3. The fair value of each share option is 20 naira. During 20X1, 20 employees leave and the entity estimates that 20% of the employees will leave during the 3-year period. During 20X2, a further 25 employees leave and the entity now estimates that 25% of its employees will leave during the 3-year period. During 20X3, a further 10 employees leave required. Calculate the remuneration expense that will be recognized in respect of the share-based payment transaction for each of the 3 years ended 31st December 20X3.
Okay, thank you. So you have had it. Now, we are asked to, if you look at the requirement is very important. What they ask us to do is to calculate the remuneration expense that will be recognized in respect of the share-based payment transaction for each of the 3 years ended 31st December 2000 and what? 3. Please pay attention to this very well. So, for each of the 3 years, what's the first year? 20 years one. 20 years one. So at the end of 20x1, how are we going to determine the remuneration expense? Ordinarily, ultimately, we will see the double entry for this transaction is always debit remuneration expense, credit and option reserve, which will be in equity. But how do we even calculate it? So year one, the most important part of this thing is your ability to get the estimates of employees that will remain at vesting dates. That's the most important part. That is where students find this difficult, and it's not difficult. Because, again, let me say it again. The employees that will ultimately get this share option are those that will meet the service condition. If you do not meet the service condition, you won't get it. It's not about staying to the end of this year. It's about staying to the end of the service period. So if it is 3 years, you have to be there to the end of the 3 years. If it is 4 years, you have to be there to the end of the 4 years. If for whatever reason you are not there, you won't get it. You will lose it. So, because we cannot wait till that time before we start accounting for it. Reporting requires that you have to start matching the expense with whatever value you want to. That's matching concept. So in year one now, we need to estimate the number of employees that will remain at the vesting date. So in this case now, when is the vesting date? It's not humanly possible to know. We can only estimate. So now it's not left to you. The question will give you all the clue you need on the number of people that will remain. Or the number of people that will what? Remain. That is, your mind has to be that. Has to go there. Don't focus on the number that will remain at the end of this year. No. It's the number that will remain when? At the vesting date. Now, from this question now, if you look at it, we were told that during 2001, during what? 2001, 20 employees leave in 2001 only. Abi? They now say that on that basis, the entity now estimates that 20% of employees will leave over the what? Over the 3 years. Now, that's the clue they gave us. In 2021 now, can anybody from that clue tell me the estimate of the number of employees that will remain at the vesting date? That's correct. How did you get 300, Ditaji? Tell me, how did you get 300? How did you get 300? Tell me. No, you cannot add 20 again. That will be double counting. Are you with me? That will be double counting if you add 20 again. Because that 20% of estimate that will leave is already over the 3 years. Okay? They already gave us estimate of people that will live over the 3 years. So if you now do 20% of 400, that is 80, Abi. You now add 20 again. People that actually left. Yes, because this is the end of the year. We will know the people that actually left in year one. But that is not the focus. The focus is the number of people that would eventually leave so that we can know the people that will remain in the third year. So since they already gave us 20% will live over the 3 years. Do you get? So you don't have to go and add that 20 again. So now, what's the total number of employees? How many people will live over the 3 years? How did you get that? And that's how much? This is the most important thing. If you can get this, you narrow your mind to the number of people that will remain. Not this year, but that will remain, because it's those people that will remain that will get it. Okay? So, and at each year, and it's only an estimate we can make. In chapter 2, when we're talking about faithful representation, we talked about measurement uncertainty, right? Because we use a lot of estimates in reporting. This is one of the areas where we use estimates, right? Okay, 320. Now we know the number. We just need to price it. Abi, how do you measure this? It's measured at the fair value of the what? Share option. Abi, since this is a share option issue, it's measured at the fair value of the what? Share. Another thing you must never forget is this. This fair value of the share option, they will give you a lot of them. They will give you at the agreement dates. They will give you at each year end. Again, you need to know which one you are using. For equity settled, the fair value of the share option you use is the one at the grant date or the agreement date. That is the fair value of the share option you use. Is the one they give you at when? The grant date, when the agreement was entered into. And that is the one you have to use. So in this case now, and again, this is different from the fair value of the share. So it's not the market price, so it's different. So can you spot the fair value of the share option for us at the grant date in this question? Okay, that's correct, at the grant date. So let's get the fair value. So the fair value of the option is 320 employees. Abi, how many options are we giving to each employee? How much? It's not 100. Is it 100 shares or 100 share option? 100 share option. How much is the fair value of the share option at the grant date? 20 naira. So how much are we looking at? 640,000. Abi? So this is the value of the option. But we cannot recognize this entire value in year one. This is like the total value as at this date. So what goes into our expense? The remuneration expense is going to be this 640,000. What's the service period? Multiplied by what? 1/3. And how much is this? 213,333 Then the remaining balance, we just carry it forward. So the cumulative balance as at year 1 is how much? Two one three 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 three. So this is where we are going to. So of course, this is what they ask us to calculate remuneration expense. So ultimately, you know that you will debit remuneration expense in P&L, and you credit what? Option reserve. You credit what? Option reserve. With the same amount. So that closes the debit and credit in year 1. In year 2, yes, we don't need it for anything. We don't need it for anything. You might need it in another case. They tell you, the case where you will need it, where you can add it, is this. If they are told us in the question that 20 left in year 1, they now told us that 20% will leave in year 2 and year 3. Do you get the idea? Where they told us that, like they told us in this question, that 20% left in year 1, abi? But what they now told us that, on the basis of this, they now estimated that 20% will live over the 3 years. So we just estimate that, okay, 20% will live over the 3 years, and we got what will remain. But if what they had told you was that, yes, 20% left in year 1, but additional 20% will live in year 2 and year 3. So what they want you to do is just estimate those that will live in year 2 and year 3 with that 20%. Whatever you get, add it to the 20 that actually left. That's the situation where you can add it. Because the estimate they gave us is just for year 2 and year 3. Just add it to the people that actually left in year 1. That would be the situation. So in that now, which should be that's even a better scenario, because in year 1 we will know the actual people that actually left. We can just estimate for the future. Abi? But in this case, it's different. Actual people left, but they now say, okay, because of this, they estimate that 20% will leave over the period, over the 3 years period. Okay, now, in year 2, what guide did they give us in year 2?
During 2018, about 25% left and then 2 years. During the 3 years period.
Okay, so how do we get that?
Minus 25%.
They said a further 25% leave in year 2. They now estimate that 25% of the employees will leave during the 3 years. So where did you get 380?
So it will now be 400 times 25% minus 25%. 400.
No?
It's 25% of 400.
20 left
No.
Over the 400 is 25% of
Don't calculate it like that. You cannot calculate it like that. It depends on how the scenario is. Your scenario might be correct in some cases. If they are told us that the way you are doing it, Karen, you were even off how you should have done it. She will have been right if what they have told us that if what they told us is that 25% will leave next year. If they told us that additional further 25 left this year now, but 25 will leave next year. So what you will have done is that, okay, how many employees do we have? 400 minus 20 that left in year 1, minus 25 that left in year 2, minus estimate of people that will leave in year 3. That will have been correct. But in this case, what they told us is that a further 25 left. They now said the entity now estimate that 25% will leave over what? The 3 years. They just a re-estimation. So what they are doing here is that every year they are doing an estimation of total people that will live over the 3 years. So it's clear. 25 will live over the what? The 3 years. So don't go and do it dependent on page 320. No. Leave that one alone. Why are you confusing yourself? It's clear there. What they have asked us to do is clear. That yes, further people left, but they said they are now estimated. It's the estimate that is important now of people that will live over the 3 years. So if they have told us that 25% will live over the 3 years, so they have already told us what we should do.
So saying this is 25 that let's say is not.
It's not relevant because it has been replaced by the estimate that will live over the 3 years, which is why I'm telling you that where it will be relevant is if they tell us that 25% will live next year alone. That means they gave us estimate of next year alone. That's when you can consider people that left in year 1, year 2, and people that will leave next year. But this one, they have given us that 25% will live over the 3 years. So it's straight on. Okay, so we have 400. So how many people will live over the 3 years? How did you get that? That's the nature of this scenario. They can change it. That is where the challenge is. I think I've tried my best, really. Try my best. You will just go and watch the video over and over again. I'm sure you get it. So what effect do you want it to have? Okay, so your challenge is not this, it's just mathematical. You are just looking at the mathematics of how to calculate what is remaining. So at least what is important for me today for you to understand is that you understand the fact that what we are looking at is the number of employees that will remain at the end of the third year. You understand that? Okay, so if it's the mathematics, the way, if you look at the context here, is that there are, of course, people left in year 1 and year 2. The only thing here is this. What is informing my decision is that it's an entity now estimates that 25% of its employees will leave during the 3 years period. So don't see it as 25% of the remaining employee. That will, mathematically is even wrong to see it as the remaining employee. Because they are now doing a re-estimation, meaning don't use the actual. Use the estimate over the 3 years. So don't now say 25% of 400 minus 25 minus. Even the mathematics is wrong. So it has to be 25% of everybody. That is the estimate of people that will leave. It's clear. If they want you to do of the remaining people, they will not say over the 3 years. They will say next year. They will give you for year 3 alone. For them to say over the 3 years is ignore those that have left. Let's estimate again everybody. So what that shows you is this. It means that at the end of every year, they make estimates. So it's two things. Is either they estimate for everything again or estimate for the remaining years. Those are the two things that can happen. Is either they estimate for everything again. So when they're estimating for everything again, just calculate it on the total employees. Ignore the people that have left. But if they are estimating for next year, then you can now consider people that left in year 1, year 2, then estimate of people that will leave next year. Okay, so again, this is where the challenge is. And I can see that you're not getting it well. I'll use assignment to... Yes. Because Stella is one of my smart students and she's not getting it. I'll give you assignment plenty. So 300 multiplied by what? 100 multiplied by what? And that's how much? This is the new value of the option, but that's not what goes into our books. What goes into our books is 600 multiplied by what? So, and that's how much? 400,000. But is this 400,000 that goes to the P&L? What goes to the P&L? You say no. You now say 400,000 again. Thank you. Exactly. Is the expense is the increment. So it's just this is the we did 2/3. This is the cumulative for year 1 and year 2. So for us to get the one that relates to this year alone, you just do 400 minus what? This one, this cumulative from last year. So that was 186. So as at the end of year 2 now, what's the cumulative of year 1 and year 2? The cumulative of year 1 and year 2 is 400. You're not getting it, Abi. So again, you got it to this point, Abi? The fair value of whatever. Now, we want to know, okay, what portion is relating to this year? Because this is everything for the 3 years. What portion is relating to this year? So the way we do it is we're in year 2. So we do this multiplied by 2/3. That gives us the cumulative balance till the second year. Here we did 1/3. Here will be 2/3. Now, this 2/3 means for year 1 and year 2. Abi? It means for year 1 and what? Year 2. Then you just deduct this opening. That will give us relating to year 1 alone. Then the balance is what goes here. Another way is that if you look at it, this is the balance in year 1. Abi? This is what you will find in the option reserve in year 1. In year 2, you just need to increase this option reserve from 213 to the new value. Abi? That's why we're having 400,000 here. Okay? You'll be just increasing it every year. And the increase is just the year 1 and year 2 value minus the year 1 cumulative value. So which is this minus this. That gives us 186,667. Of course, the cumulative balance for year 1 and year 2 goes here. Okay, and that's why we are having that. Okay, now in 2003.
I want to ask a question. This grant date or agreement date, is it that beginning date 20x1?
4th January 20x1.
Oh, okay.
Okay, you wanted to ask a question? Say it again. Yes. Again? No, it's wrong. Okay, if that will work for you, but in accounting, whenever we get year 1 and year 2, whatever, which is what should be in your reserve. Assets, liabilities, equity is cumulative. It's cumulative, right? What goes to P&L is just relating to that year alone. So the 400 is cumulative of year 1 and year 2. The difference between year 1 and year 2 goes where? To P&L. That is how we do it in accounting. So this is the better way. So let's look at the year 3. What happened in year 3?
25
A further 10 employees left. So Karen. No, I'm calling Karen. Karen, tell me, at the end of this third year now, how many will remain? Why are you going to eliminate expense? Yeah, the main thing. How many employees will remain? How can you say no idea? Look at it, Joe. No. Let me ask you. Me. Answer, Joe. How many employees will remain?
290.
Why are you giving me? Why are you giving me clue? She wants to answer. How many? Eh?
Nothing of my
355. That's gone. Oh yeah, you want to try? Oh yeah, try now. 290. Okay. What did you say? 345. How did you get it? Can you please clap for her? And she too, the two of them. Yes, they got it. So this is the exercise date. This is the exercise date. We now know there's no need to estimate again. We now know the people that have left. That is why they didn't give you any estimate. They just told you that now in year 3, 10 people left, meaning additional 10 people left. So out of the 400 we have, how many people left in year 1? How many people left in year 2? How many people left in year 3? What do we have? Clap for her again. The two of you clap. You are not clapping, you are not getting it right, you are not clapping. You don't understand? See. In year 3, 20% what again? No, it's not 10%, it's 10 people. Please, class. He's asking a question. Yes. I didn't say we should do. It's because of my logic, yeah. Okay, yeah, I think that's a very good question. So in year 1, the reason why the logic was we used 20% of 400 was because it's clear in the question that 20 people left in year 1. They now say on that basis, we are estimating that 20% will live over the 3 years. Right? We are making estimates. Something must inform our estimate. Remember, the way you reduce measurement uncertainty is to use a scientific or mathematical approach. So, ordinarily, we have had 20 people that left. On that basis, we say 20% will live over the 3 years. That was why we use 20%. We ignored the 20 because they have given us over the 3 years. Right? In year 2, they said further 25 people left. Based on that, now they now explained that 25% will live over the 3 years. In year 3, there's no need for estimate again. They only told us that how many people left in year 3? They didn't just say 10 people left. They said a further 10 people left. So there's no need for estimate because now we know people that have left in year 1, year 2, and year 3. So you cannot just say 400 minus 10. No. 400 minus everybody that has left, which is 400 minus 20, minus 25, minus 10. In year 3, at the exercise date, they can't give you estimates. If they give you estimates, you tell them they are wrong. It's wrong. Why would they give you an estimate when we will know that these are the people that have left? How would they give you estimates? They should not. Otherwise, you ignore it and say, "Oh, God, you don't know what you are saying." Because you cannot give you estimates. They have to be. If they see, Hello. She's asking a very intelligent question. She said that if in year one, 20 people left, they give us estimate. In year two, further 25 people left. They now did not give us estimate. You have to estimate yourself. Yes. See. That's the standard. You have to estimate the number of people that will vest at the vesting date. It's about the future. So you can estimate, you can just put an assumption in your note that if you want to make it easy for you, just tell it that nobody will leave. Yes, and move on. Yes, you can say nobody will leave. So at that point, just 400 minus people that left in year one minus people that left in year two. Or you can say, okay, just do whatever estimate. It doesn't really matter, but a reasonable estimate. So the examiner does not want that. He will give you what he wants you to use. He will definitely give you. Okay? So that's 345. It's good. I'm knowing that you're not getting it straight. You get plenty assignments. Plenty. Okay. So you see, our time you need to go for break. So let me just finish this, then we'll continue next week. So this 345 multiply by what? Multiply by what? Equal to what? So this will be 690 multiply by what? And that is how much? What will go to our expense this year? They tell you. Don't say it now. So this will be 690 minus what? Which is the cumulative from year two. And that is what will be our expense in what? 290. And of course, is the cumulative that will what? That will come here. Okay, so I'll give you plenty of assignments. Right? I'll give you plenty of assignments. Though we'll come and do corrections when we come to class next week. Ordinarily, my target for next week is for us to do IS 19. And so, thank you very much.